Jeff's the one that really said 90% of the move took the last 10% of the time, and I picked up on it. But it did. I said, he's right. And I went and looked at, how many years there were in that bull market and how much it moved that last year. And that's round numbers about what happened.
So today we've got a treat for you. To say that we all have differing opinions about life, economics, a myriad of things is an understatement. And what's really neat today is what we're going to do is we're going to have I wouldn't even call it a debate, but a discussion on the different ways both Mr. Morgan and Mr. Christensen believe in silver, the industry, where the economy's headed, and we're going to be talking about that. I've got a few questions, and I'm going to moderate. Then after we go through just 3 simple questions, we're going to open up the questions to the audience as well, get you guys interacted, so start thinking about that kind of stuff. So first off, thank you, both of you, for being here. It's awesome. And do you want to we'll just play past the mic. Is that going to work out? Sure. Oh, I'll pick it up. Awesome. All right. So first off, I think the easiest thing will be to talk about the difference in your worldviews as far as economics. And I know they're both differing, so I wanted to start it out with Mr. Morgan to start talking about where you think the economy's headed. If you want to play that into the silver market, that'd be great, and we'll have Jeffrey pick it up.
Sure. And I don't think, I've known Jeff for a lot of years, and, we probably think more alike on the mechanics of, let's say, the silver market, the derivatives market, the futures market, COMEX, whatever you want to call it, than most would think. But he's really been pretty valuable to me. I remember one time, for example, that there was one of my whales that was really upset with me because the amount of silver that was in London. And he called me out on it, and I called Jeff, hung up, called Jeff, he said, well, that's Buffett silver, so I kind of nailed me back.
That's not working.
Remember that? So, worldviews, so I'm going to speak first. I'll tell you what I think, and then I'm going to kind of speak for Jeff, which I don't mean to, because he needs it, But I think the main difference, the way I see it, is that I'm more concerned about the future of the economy than Jeff. Jeff is like, oh, you guys in the newsletter business have been talking about the end of the world so frickin' long, and things just keep getting better and better, and we've had these big stumbles, and we've fallen down, and we've picked ourselves up, dusted off, and gone on, and that's just going to keep going. And one of my best mentors, Harry Brown, B-R-O-N-E, some of you may know from several of the books he wrote, he did say to me before he died, things could muddle on for a very long time. So I think I'm more pessimistic than Jeff about the economy and where we are right now. From my studies, and they're pretty vast, all Fiat fails, and I think Jeff probably would agree with that. He gets to speak next, but he would probably take a view that you're right, Dave, but we've got so much longer to go than you think. And really, to be honest, he's been right and I've been wrong in a way. We have muddled along, and we have got, new technologies. We do have iPhones. We have all this stuff. But I think we're at a point now where a lot of people are waking up to the debt problem, and it will be resolved. And I don't think the dollar's going to absolute zero. I think there will be a reset. I think the system is resetting as we speak. But I don't like what the political class is doing, and I don't like the control mechanisms that they do with the monetary system. So I say in a nutshell, I'm more pessimistic than Jeff on my worldview, and I do think that collapse is probably too strong a word, so I want to change it here now and just say I think the economy physically is contracting in most regimes, but there's always the other side of the coin. There's nothing static about an economy that's quite dynamic. So.
I'll just use this one.
Awesome.
I'm lazy. Yeah. As I said in my earlier talks, more people here, I see a world beset with problems. And you probably can't see it, but in our monthly reports on precious metals, we have these bubbles. And these green bubbles are positive for gold, bad for the world. And they move up and down in terms of how soon they're going to be problems of immediate effect, and left to right in terms of their importance to the gold price. And there are a tremendous number of bubbles out there that have been moving. They've been getting bigger, they've been becoming more important, and they've been becoming more urgent. And those bubbles were way back in the middle of that graph 2 years ago, 3 years ago. They moved into the upper right-hand quadrant last year, and now they've moved down a little bit. So they're less likely. I look at the world and I see we have a lot of problems, and we have an absence of political leaders to solve these, willing to solve these problems. They can be solved. They probably won't be solved easily. I always say I'm not an optimist, I'm a realist. And the difference, I guess, between a pessimist is a pessimist says things are going to get bad. And an optimist or a realist says things are going to get bad, but they've always been bad. Yeah, and they have. They've always been bad. I mean, and we can struggle through it. So on an economic deal, yeah, collapse is too strong of a word. There are problems. We will fight through them. There will be changes. China is going to become much more of a dominant economic factor. The United States will lose it's in the process of losing its hegemonic status on a political basis, on an economic basis, on a financial basis. It's probably not going to happen as fast as a lot of people think, because the United States still has a tremendous comparative advantage across a number of resources. The one area is currencies, and you mentioned the fiat currency will fail. And the only currency system that has not failed throughout history is the current one. And almost all of the previous systems were backed by gold or silver or both. Gold and silver don't keep currency systems from failing. You can say, well, yeah, but the gold standard here and the gold standard there, they were mucked around by politicians. Right. You know, monetary systems are mucked around by politicians and then they fail. So I happen to believe that the current international currency regime, which is what central bankers talk about, will give way to something new at some point. And I've worked with central banks since 1980, 81. And they talked about, yeah, someday the dollar will not be the de facto reserve currency, but that's decades away, and it's not inevitable. Someday the yuan will be convertible, but it's not going to be anytime in the immediate future. They said in 1981, when I was working with the People's Bank of China, and it's probably not going to be in the immediate future now. So I look at the currency regime and I say, yeah, it will fail, it will be replaced. It may not be a catastrophic failure. It's not, I hear all this stuff about a reset. Let me tell you, I have never talked to any central banker, client or otherwise, in recent years who says, oh yeah, we're working on this secret reset. That's what conflict entrepreneurs use to scare the poop out of you. Yeah, it's not there. Are we moving to current digital currencies? Absolutely, because that's progress that we're going to see. Yeah, we moved from using nails as currencies to using gold and silver coins. Then we moved from gold and silver coins to using paper backed by those gold and silver coins. Now we're in paper. Then we went to credit cards. Then we went to debit cards. And digital currencies are something that will happen. I believe that in 5, 10 years, you will have all sorts of digital currencies. They will be issued by national central banks. And private digital currencies will be as common as all of those tech stocks that went bust in 2001. Because if you look at a model and you say, what am I looking at with digital currencies, private sector digital currencies? You listened to your partner yesterday, and he was saying, well, I made 35,000% on this one, but I lost everything on that one. That's not an investment. That's like a slot machine. Yeah. But I don't think that a casino is the right metaphor for private sector digital currencies. I think that what the right metaphor or historical comparison is the tech stock boom. Tens of thousands of stocks. Oh, three guys just out of college with a 5-page business plan, and someone gives them $1 billion. And that $1 billion evaporates like uranium money in the 70s or the 2020s. So I don't see us going back to a gold standard. I do see us moving forward with periodic bouts of economic and financial problems.
Awesome. All right, so I'm glad you brought up the tech boom, because I think it's really important to delineate, or no, to define the word collapse. Everybody has a different meaning for the word collapse, right? I'm glad you're looking for the best way to describe things. It's like the day before Lehman Brothers collapses, Jim Cramer is out there saying Lehman's a buy, right? Well, I've found through the last two cycles, both the dot-com bust and the 2008 financial crisis, major indices took about a 50% haircut across the board in both of those, right? I would define that personally as a collapse. The first part of this question is, what is your definition of a collapse? So how far does it have to get, how high does inflation have to go, or how low does the major indices have to go before we go, okay, we're in a collapse? And then the second question is the last time we saw the Great Recession start, were either of you publishing any work warning people about it? Because it's one thing to take one side, and then some people like to take the other side because there's not a lot of play or attention on those sides. So it's a two-part question, and I'd love for Jeffrey to start out. Just bounce you guys back and forth to make it even.
Yeah, we were telling people as early as 2004, 2005. First off, we were saying that commodity supercycle was nothing but marketing hype.
Okay.
And then it was economics 101 that were driving up prices up. But probably around 2004, 2005, we were talking about, to our clients and others, anybody who would listen, that we thought that there would be another recession, that it could be very deep. We thought it was going to come in 2009.
Okay.
And we thought that there'd be a global financial crisis. You looked at the housing market. We picked up a whole bunch of clients 2004, 2005, one of the leading indicators. People who had made a fortune in real estate across the United States and around the world, who were selling out their real estate portfolios and buying silver and gold.
Yes.
And they became clients of ours. And we saw this influx. It's sort of like, hey, there's a bunch of flies in the backyard. It must be springtime. Oh, wow, there's a bunch of real estate investors buying gold and silver, selling all their real estate. So we started looking at it, and the collateralized mortgage obligations were a joke. We had seen all of the financial market crap in 2000, 2001, not just Enron and others, but then all of the re-rating of private options, all of the rip-offs. Sarbanes-Oxley was put in place to try to deal with those things. You looked at Sarbanes-Oxley and said, this doesn't do anything to solve those financial irregularities, but it's going to make the economy that much more fragile. So we were warning people then, and we continue to.
Perfect. So then what about the first part of the question? How would you define a collapse? Let's give it a percentage, or how bad does it have to be for someone in your position to say, we're in a collapse?
See, I just don't use the word collapse.
Okay.
I will use the word collapse, and we'll have these extreme things. We did some work in the 90s about, what would it take for the gold price to collapse, you know? And it was a client, mining client, that asked us to do that. I would define a collapse as a breakdown of civil society, political authority, and economic well-being.
So it sounds like the Great Depression probably wouldn't fit in your definition of a collapse then, because there was an unemployment issue with a massive drop in the stock market
I think the
values.
Great Depression, the first 4 years of the Great Depression probably would be a definition of a collapse to me.
Okay.
Because what you saw was a breakdown in civil society, a breakdown in political authority, a breakdown in financial activity. You had thousands of U.S. banks close. You had a tremendous amount of money withdrawn. You had people, you probably had 30% of the world's wealth go into gold, if not be in gold, during those first 4 years.
Okay, perfect. I would want to get a baseline. Mr. Morgan.
So a financial collapse, and I'll get to the collapse. But a financial collapse, and I've had this, discussion many times. And usually people are fairly upset. But in a financial collapse, I'm going to speak for you, but a lot of people picture a financial collapse as everything in the world burns to the ground, there's smoldering ashes, and all these, little flames are being put out. That's their a metaphor for what they think about a collapse, which couldn't be more inaccurate.
Yeah.
In a financial collapse, nothing changes physically. All the buildings are there, all the wheat fields, all the oil, all the cars, all the workers, industry, factories, everything stays there. What changes is the ownership in a financial collapse. That's what happens. So the physical economy doesn't change. What changes in a debt liquidating depression like the 30s is the people that were over leveraged lose their asset to somebody that's got enough liquidity to buy it for pennies on the dollar. But as Jeff said, and probably better said to me, so now I get to use his stuff, he's right. A total collapse is usually set off by a financial collapse, but not always, because when I went through the collapse of complex societies, which I would suggest most of you read, it went all the way back to the Byzantine, Mesopotamian, Persian, Mayan empires, and it talked about the collapse of complex societies going all the way back. And I got halfway through. It was a bit of an academic slug, and I said, oh, man, okay, but I pushed myself through because I got to read this book because I want that epiphany moment, right? And, there's an academic after every chapter. It wasn't war. It was, agriculture. It was this. Sometimes it was monetary, whatever, climate, whatever. So I said, what am I getting out of this? I probably could have come to this conclusion without reading the
20
book.
pages.
But I was a little upset that, I didn't get anything, really, and then I did. And here's what I, came to, is it didn't really matter too much if it was war or famine or climate or the water supply or whatever. Whatever it was that started that collapse of that empire, it couldn't be turned around. That was what I found out. So if it was weather and they had to move and migrate, dissipated the population, some couldn't get out in time, too much hardship. So that's a little bit frightening, but it doesn't mean the end of the world. I mean, to me, it's a cycle that's happened again and again and again. It just happens to be my belief that we are there now, or close to it, I'll say, or getting closer. Again, to go back to the original statement, Jeff probably thinks it's further out than I do. And, you can judge for yourself if, but it's going to be apparent to everybody as, it takes place or is it taking place. I have to concur that the system changing, whatever the reset really means, could be articulated by none other than Carney from the Bank of England. He's no longer the head, and he said exactly what they want at Jackson Hole. He said it in the UN, and he said it in front of the Bank of England. But just because that's what they want doesn't mean the market's going to go how he wants, right? So there's a lot of unknowns in life, and how the financial system actually shakes out exactly, I don't think anybody knows, although there are, let's say, some rather egotistical, powerful financial types that think that they could control it. There will be give and takes in the system as it continues on the path we're on.
All right, cool. So another question is about the CPM group, because that's actually a question that I've had for a long time. And so I wanted to get some clarification on it, and then let's see how I can word it, if I can word it properly. CPM group works a lot in the derivatives market, correct?
Well, yeah.
Okay, and so is part of that, I believe, if I heard it right before, in that derivatives market, CPM works on the pricing with financial institutions on finding a good price for the options market. Is that correct?
No, I'm not quite sure what you mean. We work with, our business line options is primarily with investors
Okay,
and producers and consumers.
perfect.
And we will work with them to make sure that they have optimal pricing.
Perfect. Okay, so you're giving them expert advice to make sure that they're entering or exiting a position at the right time, the optimal time.
Let me give you an anecdote. I was at a World Bank conference on commodity derivatives.
Okay.
We were doing a lot of work with the World Bank on commodity derivatives in the 90s and aughties. And there was this academic economist, and he said, the efficient market theory says that commodity options should be priced at this level. But as you look at across commodities, the price levels are much higher.
Okay.
So, Mr. Christian, what's wrong here? And I said, what's wrong here is that you think that the efficient market theory says that if you have an efficient market, by which you mean you have information spread evenly across all participants, then you have this kind of price. But the commodities markets, all financial markets are inefficient to some extent.
Okay.
And just ask any high-frequency trader in the stock market.
Yep.
You know, the most liquid market. And the commodities markets are incredibly asymmetrical.
Okay.
They are incredibly inefficient. And that inefficiency leads to higher commodity price, options pricing than you would expect if you thought that this was a 100% efficient market.
Okay.
So what we do is we go in there and say, okay, let's say that you have a certain inefficiency in that you're asking a bank, and it's amazing the number of mining companies and others who say, okay, I'm going to go ask my counterpart what I should do, how I should structure my hedge, and what it should be priced at.
Yeah.
And one of the things that CPM Group does is we work with, let's say, a mining company. Say, okay, we have a model. Here's what this option should be priced at. Let's go to your bank. Let's also set up 2 other banks to trade with you.
Okay.
And let's go to all 3 banks and say, we want to do this option, what's your price?
Yeah.
And then, so go back to the best one and say, you know, that was good, but I'd like a little bit better.
Okay.
You counterbid.
Gotcha. Okay, so that's good because I wanted to see how far CPM works in the derivatives market, because I know one of the big things in the silver world that you have, I wouldn't say argue, but your stance is, that there's not going to be any type of supply crunch. That there's plenty of silver to go around, but there's a lot of people that are wanting to get into that physical realm and talk about the actual physical realm of silver. And I'm going to butcher this quote by Mike Maloney, but he said that gold and silver always does an accounting for all paper printing eventually. And if that is the case, and Mike Maloney is correct, I would like to ask both of you, what would that look like based on today's, in my opinion, out of control printing? Would we see a large price spike or quite possibly a silver squeeze possibly, or a gold squeeze, because at a certain point people would start to believe that things are getting a little nutty, we're going to try and dive our money into gold and silver? Hopefully I asked that question right. I probably totally butchered it.
Well, if you'd allow me to take it first, because I think I got the gist of it. I think he asked 2
I probably confused Jeff, so.
I'll let you go first. I mean, but I'll say this as a preface.
Yeah.
You've got like 3 different, very, very distinct topics
Yeah, you're right.
stacked up.
I like to throw a lot in the
We'll
mix for you.
unbundle them.
All right, cool.
So I think I can unravel. So number 1 is, what's the theoretical paper price of gold? I wrote one of the first articles I wrote for the internet was called Engineering the Price of Gold. And in that, I took base money, which is physical currency, because gold is a currency. I mean, you're on a gold coin standard, that's what you're trading with, right? So it's the amount of paper divided by the amount of gold. So if you took the M0 base money in 2000, divided by the 265 million ounces that the Treasury says it has, it's a division problem. You could do this in 2nd grade, and that number was $2,500 an ounce. Gold was selling around the $300 an ounce level at that time. Now, in that article, I talked about, is this just theory? And I pointed out that during the inflationary end in 1979 going into 1980, the same division problem came out to $400 an ounce gold. And yet the price went intraday to about $850 in the spot market, $875 in the near month. So we actually were double the price for that day in the gold market. So that's what Mike's talking about. If you do it today, I haven't done the math in a while, but it's somewhere around 15,000. But does that mean that the price is going to get to that level? And that's the second part that you asked. And that presupposes there's what I would call panic buying, which is what I think we saw in the late '79. I mean, if you look at 1979, the beginning, silver hit an all-time high of $6. And then a year later, it was eightfold. And Jeff's the one who really said 90% of the move comes the last 10% of the time. I picked up on it. But it did. I said, he's right. And I went and looked at, how many years there were in that bull market and how much it moved that last year. And that's round numbers about what happened. So what most people don't talk about is when it came back down, it averaged $20 an ounce for that year. So even though it started at an all-time high in 1979 at $6, and it went to 50 for one day, the average price for the year was 3 times higher than the all-time high at the beginning of that year, which I think is pretty interesting. So does that mean it's going to happen again? That silver will be repriced like that or not? I don't know. But it would take a lot of buying pressure. But, to be more aligned with what Jeff Clark said in the first presentation here, there's a very small silver market, and there's a lot of scared money that's kind of sitting there. And it doesn't take much of that to move into the silver market to get a much higher price. And I do believe that's going to happen, but I am talking my own book. But I don't, I've always tried to be consistent about everyone should own a little, and that's a different number for everybody. But very few people are aware of the silver market. It's just not something that Wall Street really talks about very much, for whatever reason. So, and I forget the third question. Jeff's memory's maybe better than mine, but those are the two I heard.
That's all right, I confused you, it's okay.
Okay. Let me start by just building on what Dave said. If you look at private sector financial wealth in the world, 0.025% of it was in silver at the peak of silver. And
Yeah, extremely
now
small.
it's like 0.01%. So when Jeff was talking about, well, if 1% of the world's wealth went into silver, the price got, I'll take 0.05. I'll take 0.05 of 1%, and you'll have record silver prices. It's a minuscule market.
Yeah.
Now, unpacking the things you stacked up.
Yes.
The first one is that I want to talk about is the second one, which is the shortage of physical silver.
Yeah.
And that has nothing to do with the derivatives markets.
Okay.
I'll get back to that,
Perfect.
which was your first comment. You have to look at the data on the supply and demand of physical metal, and you see 3 billion ounces of silver held in above-ground bullion inventories and 2 billion ounces in coins, and 18 billion ounces in reserves, mineable reserves. There's no shortage of physical silver. There could be temporary shortage, as there was in early 1980, when all those people who are holding all that silver see the price rising sharply, and they say, I'm not a seller at $20. I'm not a seller at $28. I'm not a seller at $30. I'm not a seller at $50. And the price can go parabolic, rhodium went to $30,000. Did anybody buy at $30,000? I don't know. So the first thing I'd say is there's no shortage of silver. There can be periods of time when those people who hold the silver say, I'm not selling, which goes back to what you were talking about with the redistribution of wealth in a financial collapse. The second thing was you were talking about the derivatives.
Yes.
And one of the classic mistakes that are made over and over again by people who are talking about $10,000 gold or $1,500 silver, like Mike Maloney, is that those people who are investing or speculating in futures and options want physical metal. Yeah. And they do not. They want exposure to silver price changes. Yeah. And if you say, okay, futures and options, they're against God's will. We're banning them tomorrow. So those guys aren't going to say, oh, well, then I'll buy physical silver. They'll say, well, okay, I'm going to go down to the casino.
Yeah.
Or I'm going to go back into stocks. They are buying leveraged exposure to price changes, and that's what they want to buy. They don't want to buy physical metal.
Yeah.
Right? So that's the second thing. So you've got a physical issue, is there a shortage of silver? And then you've got a derivatives issue, which is kind of unrelated. And then the third thing is, Mike's comment about gold and silver ultimately.
It's like they do in accounting for all the paper printing. Eventually, it catches up. And I think he was referring to past historical
Yeah, you know what?
fiat currencies.
Mike has a funny way of playing with statistics, and it's sort of like, put it this way, there are tens of thousands, hundreds of thousands of economists and financial analysts around the world, and they look at certain statistics and they say, yeah, this is the acceptable, intelligent, logical, mathematically supportable way of looking at it. And then there's Mike. And
Gonna have to get Mike up here.
he's been asked strongly by his employers to never mention CPM or me again in public. And that's fine by me. I told them, as far as I'm concerned, that's unilateral.
Oh, wow. Okay.
But,
It's good to know.
I don't think that that's actually true.
Okay.
I think that if you went back and you looked at the Napoleonic Wars,
Okay.
or even Agincourt, Henry V's attack on France in 1415, I think that you look at that and Napoleonic Wars and the wars of conquest and the age of conquest and the Great Depression, I'm not sure that the financial balance sheet of the world ever is fully reflected in the gold and silver prices. Comes close at times,
Yeah.
perhaps, but it's not. We've had clients, like a mining client, said, Jeff, what's the relationship between money supply and gold supply?
Okay.
In the world. Say, okay, well, that's easy. Do you want M1, narrow money supply, M2, broader money supply, or MZM, broad money supply? Do you want US or OECD, or global money supply? And they say, I don't know, what's the difference? I say, well, you see, it's a complex system,
Yeah.
and you want to simplify it. I was at a Bloomberg Gold conference once, and this guy was saying, well, if we went back to a gold standard, given M1, the gold price would have to be $10,000.
Yeah.
And I said, okay, are you talking about a classic gold system, gold standard, with 40% cover? I mean, that's what Switzerland and France and Germany and England and the United States all had. You had to have 40% of your currency in circulation backed by gold.
Yeah.
And he said, what's that matter? I said, well, it matters because if you're talking about going back to a gold standard, that's what a gold standard was. It wasn't 100% backing, it was 40%. And if you're thinking, and you did your calculations based on 100% backing, but it's actually 40%, then the price would be $4,000 on a gold standard, not $10,000, and you're off by 150%. And he said, so what's your point? I said, my point is you don't know what you're talking about, and you're standing on top of this platform at Bloomberg conference acting like a gold expert, and you didn't even know that a gold standard traditionally has a 40% cover.
Yeah. I'm glad you used the word, it's a complex system, because that is the understatement of the century. And it's funny because I remember in 2005 talking about credit default swaps and mortgage-backed securities, and I was getting that too. It's a complicated system. There's a lot to it. And I said, it's complicated until the day it's not. And then we all sort of figure out as it unravels, oh, wait, we see it all in front of us. So I'd love to open this time up for some questions.
Can I interrupt for just
Yeah,
a second?
please.
I remember the third part of your
Oh,
question.
sweet.
I'm getting older.
Are you? No, it's
Yes, I did. I didn't have a direct line to Michael Burry, but I did see the real estate system being way overheated.
Yeah.
And I did a couple public domain articles about get out now kind of thing. And Jeff had clients. I don't know if my client base went up during that time frame or not. Probably did.
Yeah, we had some mutual clients.
But yeah, so yes, I did.
That's
I did
awesome.
See that coming.
Because I think it's really important. And Jeffrey, you'd said, was it public, the stuff you're doing, or was it with just clients?
all
when you're,
public.
okay, cool. Because it's really important for people when they do research and who they're listening to always go back, I think, to the last cycle and see what they were saying right before it happened. I think it's really neat.
Yeah, talking about complex, because that's really important,
Yeah.
and people don't realize it. I mean, back in the 90s and early aughts, you'd be at these meetings with the Treasury and the Fed and various bankers. And the Treasury and the Fed, despite what the newsletter writers, other than Dave, would say, saying, these guys say, well, these guys don't know shit, And say, well, actually, the Treasury and Fed would call these meetings together, we get this enormous imbalance between the underlying base mortgages and the derivatives based on them. And it's true in mortgages, it's true in equities, it's true in commodities, it's true, and we have all of this currency stuff. And they were really focusing on currencies and this enormous derivative pyramid built on top of a smaller base. And the bankers would immediately say, it's okay because it will all net out.
Yeah.
And then somebody, some wag like me would say, it's okay if it can all net out simultaneously. But if one of those guys who's borrowed an asset somewhere in that chain has gone bankrupt and the bankruptcy court judge says, no assets leave until we figure this out.
You've just affected a bunch.
Yeah, and you see that over and over again. You see it in equities. And that was one of the things that broke down the mortgage system. And one of the things that was most horrible about the mortgage system, people say, well, we don't know who actually owns these mortgages. Yes, you do. It was very clear who owned those mortgages.
Well, I know we're getting close
Sorry.
on time. No, it's great. We've got about 15 minutes left, and I do want to open this up to get any questions. Anyone have any questions? Sweet. All right, you were first.
If there's no apparent shortage of physical silver, why are refiners buying back 1,000 ounce bars off the exchanges to resell, and they can still make an arbitrage doing that?
Because they can make an arbitrage doing that.
But why are they just not refining more bars? I would propose that they can't get enough mine supply from here to satisfy the immediate.
And has any refiner told you that he's at capacity and he can't find raw materials to cast 1,000 ounce bars?
But they're refining, they're paying below spot.
Yeah. If I'm a refiner and people want 1,000 ounce bars, more than I can make them and I can buy them. You know, we were involved in a different metal, it was the same problem, a client that had taken a large position and he had left it with his refiner. And he hired us because he had some issues about all that. And we said, okay, the refiner's leasing out your metal. So the first thing we're going to do is take delivery of that metal and move it out of that refinery. All right? And in precious metals, in gold and silver, it's 2 days delivery. In platinum group metals, it's 5 days delivery. Like 3 months later, the refinery delivered the metal. And a lot of it had been refined in years subsequent to the time when this guy had bought it. Right? So there are several things. First off, if I'm a refiner and people are paying me really good prices for 1,000 ounce bars, I will refine as many as I can. And if I can buy them elsewhere, from the COMEX or anywhere else, and you don't buy from the COMEX, you buy from people who have depository receipts in the COMEX. If I can arbitrage and buy more 1,000 ounce bars at a lower price than I can sell it to somebody, I will do that too.
From what I understand, though, Andrew Maguire said he's never seen this in over 30 years.
Yeah, well, Andrew Maguire was a car leasing agent. He never worked in the banking system.
He's been a bully for a long time.
I'm sorry, sir? No, I'm asking him.
I have a follow-up to that. You said that several times, that he was a car leasing agent, he did not have experience, but you have not proven that. That is conjecture on your part?
No, it's not.
Prove it.
No, I have his resume. I have his resume from his ex-wife. I have his resume from his ex-wife.
So actually, that actually brings up a great point, because the whole world is about proof, right? We always want to be able to acknowledge truth.
Well, the proof actually is on the other side. When GATA started paying Andrew Maguire to make these allegations, people said, hey, Andrew, prove that. And the Wall Street Journal, the New York Times, the Financial Times, BBC, NBC, all said, can you prove that you actually worked in the banking industry? Show us a pay stub. And he refused to do it. And when we asked GATA, they said, hey, have you guys vetted this guy? Bill Murphy's comment was, we're not a journalistic outlet. We are not responsible for vetting the people that we bring forward.
Jeff, that's not proving a negative. You made a statement against the character.
I have the proof, but I wouldn't give it to you because you're an asshole.
Well, let me ask you this, Jeff.
That is unreasonable.
Do I have to prove that you're an asshole?
You're a narcissist and you're an asshole.
Do I have to prove that you're an asshole? I will tell you this, the S&P and Dow Jones, The S&P and Dow Jones are not exchanges.
Somebody that most people in this industry see as having more
Integrity.
integrity than you do.
Yeah.
You run your mouth, you never prove anything. I asked you to prove it, you won't prove it.
So let me-
You're impugning the
So-
character of somebody else.
so let
You
me-
step up and prove it.
Yeah.
So actually, so this great brings up a great point, because yeah, it's hard to say things about somebody if you're not willing to put out the proof. Are
I
you
got the
willing to put it out like on a website or something like that?
Let me interject here, and it's unfortunate we went down the
Yeah,
Maguire
sorry.
Road, but,
Yeah.
you know, I was at the conference that Jeff brought that up, and he had pretty good proof, in my opinion, with talking to his ex-wife, and I think she came to you, right?
She came to me.
And so, you know, to the best of my knowledge, he has never proven. In fact, I think he actually called me and asked me if I knew anybody in the trading desks that had ever heard of Andrew Maguire. And I said, I'd get back to you. No, I can't find anybody that has. Doesn't prove that he didn't, but with my circuit of connections, no. The answer is no, I can't find it.
Yeah.
And so there was a couple articles. You can still search them on the web. One's by Kit Cohen. I think there's one other out there. Because this came up with one of my guys. He was a big fan of that name. And he got very angry with me. And I said, well, look, here's what's still on the web regarding his background. And I don't know Rob for certain, but I think there's enough circumstantial evidence that, you know, some things you can't prove beyond the shadow of a doubt. But why don't you take another minute if you want and just say what his wife told you as far as being, a lead?
Well, let's
leasing
not talk,
company,
well,
right?
okay, I'll take a minute about that, but then let's get back to the 1,000-ounce bars. Okay. Andrew Maguire came from nowhere and said that he had worked at J. Aaron, right? He had not worked at J. Aaron. He has no record. They have no record of him. Goldman Sachs has no record of him. He then made a bunch of allegations. Gatta and Eric Sprott and Eric King started using him to promote these conspiracy theories. I said, I just don't think this guy's real. And I wasn't alone. Almost everybody in the precious metals business, the real precious metals business, said, we've never heard of him. We don't think he's real. These allegations don't make sense. We think he's a Walter Mitty type of guy. I just ignored him because he's a gigantic distraction to what's really important to the market. Several years later, I get a call from this lady who said, you know, you're one of the few people that I find who actually came forward and said he was a false. And do you want to know the true history of him? I said, yeah, because I'm his ex-wife. And she gave me his resume. She said she was coming forth. They had gotten divorced in an acrimonious divorce, and that was one thing. But now he was finally, for the first time in his life, making some decent money, and he had disowned his daughter, and that was the last straw for her. I gave the evidence to a company that I will not name, and they went off and hired private investigators and verified everything she said. I did that, and then I made the comment at the Silver Summit where David was in the audience. So that's fine. And I got in trouble then because, you see, it's not illegal in some countries to go around lying about what you've done in the past. Oh, in his defense, he said, well, no, I worked at J. Aaron in Nova Scotia. And J. Aaron never had a Nova Scotia office. In some countries, it's not illegal to say I did this, that, and the other thing. But it is illegal if you go to financial investors and say, I'm starting a fund and I have 30 years of experience, I'm going to do this. And there was a regulator waiting for him to start this fund because then it's financial fraud. And they got really pissed at me because they were waiting to pounce on him. And when I revealed what he was, he pulled the fund for a while. So that's that.
Jeffrey, can I jump in? I think there might have been a misunderstanding on the 1,000-ounce bars, and so I'll let you know.
1,000-ounce.
Yeah, if I heard it right, you're stating that there are refiners that are having a hard time sourcing enough silver for the demand, so they decided to go and take delivery through some through the COMEX, which means they would be paying a premium over what they're normally paying to miners. And so he's saying that there's a refinery out there that's saying, look, I need the product so bad, I'm willing to pay a little bit more than I normally get it from mine supply. So would that prove, if that is in fact the case, yeah, an indication, or would it prove a real serious tightness in the market?
Well, if that were the case, that's true, but it's not the case. What's happening is the refiners are running flat out to produce 1,000-ounce bars from scrap and from mine, doré, and such. And they're doing very well. And there is an arbitrage between what you can buy 1,000-ounce bars in some markets and what you can sell it to other people. So in addition to refining as much silver as you can and selling it at a profit, you can make additional profits by buying already refined bars and reselling them. That's what a trader does, right? And that's what's happening.
But it just means that the demand's greater than the supply then.
The critical point is where are those 1,000-ounce bars residing?
Exactly.
We trade them, and our clients are holding them, and they intend to hold them permanently. And this is growing, and we're a tiny company, we just started a year ago.
Yeah.
People are buying en masse with no intention of selling it 5, 10, 15 years. I can see the huge amount of physical silver is getting locked up and never to be available for sale.
Well, as Ronald Reagan said, never's a long time. And ask me,
Never, I mean 5, 10 years.
ask me when the price is $50. Yeah. I mean, I remember a transaction that we were doing with the central bank, and Morgan Stanley was doing the transaction and we were advising them. And this is back when gold was like $330 an ounce. And I said, you know, I think that if the price gets to 380, they'll buy the position back. And Morgan said, no, they'll buy it back at 370. And they bought it back at 350. Yeah.
So we got time for one more question, but I just need to go on record and say I was not always into economics. I worked at a place called the Plump Chicken and had to wear a pink shirt. So hopefully my past doesn't dictate my future, just to touch on the past. Yeah, so if I start a fund someday, just remember this is full disclosure, okay? Let me jump back. I know you had your hand up a little bit. Chris, yeah.
So all of the commodities are up. And silver is consistently down, keeps going down. Is there any, do you have any proof that the market is not manipulating?
Well, again, as the guy just said, it's hard to prove a negative. But yeah, there's a lot of evidence that the market's not manipulated. First off, if you look across all commodities, not all commodities are up except silver. There's all kinds of movements up and down. Silver is, okay, so that's one thing. The second thing is, what's the allegations of manipulations? What we've seen in recent years, and actually just in a couple days ago, are that you're finding what they call spoofing, which is a trader sort of putting up bids and then taking them down. And you're finding more of that because the CFTC about 10 years ago bought a new computer, brought in a new head of market surveillance and investigations, brought in new computers, brought in new people, staffed up, and started following the markets much more carefully. If you saw my presentation yesterday, I was showing you some evidence that where you look and somebody says, oh, someone came in and whacked the silver market, smashed it down with 30,000 contracts. And you look and you say, well, what actually happened in that time period? What you find was it wasn't a single entity doing 30,000 contracts at once. It was hundreds, if not thousands, of separate entities doing those contracts over, in some cases, more than an hour. So it's 5,000 contracts here. It starts with 1,000 contracts, and that hits a technical sell point, and the computers that all these investors and traders use say, oh, if the price has fallen below 28.70, then sell. So they sell, and so you have 1,000 contracts trigger that sell, and then the next 10 minutes you have 3,000 contracts, and the price goes down to 227, and that triggers more sells, and then the next 10-minute period you have 5,000 contracts, and over a half hour you have 30,000 contracts. And then you go into the data and you see that it actually wasn't the same entity, it was actually hundreds of entities. So the data does exist. Now, So that kind of proves it. Then you can sort of, it proves that it wasn't one entity whacking the market.
But one of them was J.P. Morgan, right? We have the proof because of fines paid.
No, the J.P. Morgan was fined and found guilty of spoofing the market.
Exactly.
Repeatedly.
Yeah, yeah.
But it wasn't like doing 30,000 contracts to smash the price down.
Okay.
It was putting in false bids.
And you, like you just said, there's multiple groups that have been
And
doing
people,
this.
you know, the thing is, you find that kind of spoofing across all markets.
Do you think they do it at the same time? That where multiple groups could be spoofing the market to where it could add to that
Well-
much of a sell-off? Like a coordinated event?
It's not so much spoofing. What happened? There's no coordination. I mean,
Okay.
these guys don't even talk to their own desk mates. I
Yeah.
mean, if you look at Barclays was found guilty. There was an options trader on Barclays who was found guilty of putting in some options bids against his client.
Okay.
And when the CFTC, well, that was actually the FCA, looked at it, what they found was that this guy did this, and that his supervisors were unaware he did it. And in fact, the Barclays chief options dealer didn't know he had done it.
Yeah.
So not only is he not coordinating with other banks, he's not even coordinating within his own bank. So he was fined, he was banned from trading precious metals, and Barclays was fined for non-supervision.
Do you think it's ever, I'm sorry, and I want to give, we only got like 2 minutes. I want to give David an answer, time, but you know, remember two rogue oil traders that ran the oil price up in 2008, I believe, from $120 to $138. It was these two rogue traders. And we do hear that a lot when banks are fined. It's usually, there was no collusion, I was working by myself. Do you think it maybe, quite possibly, it could be possible that there was collusion, but there's always a point guy? There's always, we're going to make sure that you're the one that takes the fall for this, because if in fact there was collusion between multiple entities or banks, or that there was more than one or two people at a trading desk, you know, none of their supervisors knew, it would lead to a larger problem.
So if you took that question to a judge in a court of law, he would say, get out of my court and go write a novel, because that's pure supposition. You have absolutely no evidence.
But that's the beginning of all court cases, right? A theory or a thesis,
First,
and then you have to bring
discovery.
proof. Yeah, totally.
Discover it, because no one's discovered it yet.
Yeah. Okay.
you know.
It would-
And there's
Oh.
never been a fall guy who's written his memoir saying, I was the fall guy at the XYZ bank.
Well, that's true, because I don't think he'd live to publish
There
that
was a
book.
guy who
Yeah.
wrote a thing, there was a guy who wrote a
Epstein.
novel which became a bestseller about ripping off the World Bank or something like that, and then they found out that he was actually psychotic.
It's usually
he
a
had
good
a
one. You know, that dude's
bestseller.
crazy, right? Don't listen to
He had
him.
a
My bank's
bestseller.
totally good. That dude's crazy. David, do you? Oh, we only have a few minutes.
Yeah,
I'm
well,
sorry.
in the Silver Manifesto, there's a couple chapters. One's about, you know, how bullion banking works, fractional reserve in that entity, and also I wrote a chapter on the manipulation, and I use the Sharpe's ratio. It doesn't prove it, but it's a pretty good case. It goes between the London market and the New York market. So I think it's only about 3 pages long. It's not very hard to understand, so you can read those 2 chapters and maybe see the other side.
Cool. You know, I want to. We're going to move to the next segment, but I want to thank you both for jumping up here. I thought there'd be more fist fighting, to be honest with you, so I'm just like, no, I'm joking.
Sorry.
No, but I really do appreciate both of you guys taking the time and doing this, because I love hearing both sides of the story. So if you guys don't mind, let's give them both an awesome round of applause. Thank you.